All right, we are live. Sam, welcome to the Founders Lounge.
Hi there, Mattis. Thanks for having me.
Absolute pleasure to finally get a chance to catch up with you. So, as I always like to say, and as I was telling you before, let's just kind of start at the beginning. You are and have been involved with a few different businesses, which is always interesting. So, I hope we'll have a chance to touch on all of those. But I think one of the first things for you was the property business, right? The Eydin, is that? I don't know how that's pronounced.
Yeah, Eydin, Eydin,
Eden.
Eydin Limited. Yeah, it's got a nice
Yes.
etymology. So Edinburgh, it used to be like the borough of Eden, like Eden
Aha.
Borough. So it also had
Aha.
other old names like Din Eden, and my property company, Eden Limited, is an Edinburgh property investment company. So I like the name
Got it.
Eydin.
Okay. That makes sense. I'm glad you explained that. So I learned something new about Edinburgh as well. Um I think you got involved with that when you were pretty young. So can you talk a little bit about, how that started? I know you actually delivered some really great results there already early on, and generally I'm interested in property. I don't know much about it, but a lot of people seem to be involved in it. So hopefully we can learn
It's a
something new about it today.
it's definitely a polarizing subject. Painful for some people when they look at how much they've spent on rent over the years. Wonderful from others when they look at how much their property values have increased. So, when I was in university, I grew up in Edinburgh and I decided to stay in Edinburgh University to be close to family. And when I went to university, I was also working full time in property lettings. And the university really inspired me to start my first business. There was a great entrepreneurship club there, and they had really good speakers of other local entrepreneurs, many of them who were in their early 20s and had started to build really interesting and successful businesses. So I actually dropped out of university. I initially paused for a year to start a property advertising business. And that was like my very first company. It was a company called Advance to Go, and we built property advertising software. Um, Eden Limited came a little bit after. Do you want me to focus on Eden first, or start on like the first? Do you want it chronologically,
What
or not?
whatever I tend to quite like to go chronologically because I think it gives a kind of background and a context for me to understand where you're coming from and for everyone else. So whatever you think makes more sense.
Yeah, I think it does too. So the first business was Advance to Go, and we kind of realized that when I worked in lettings, one of the big frustrations was to advertise a property. Your big marketplaces in the UK were Rightmove, Zoopla, and Gumtree, but Rightmove and Zoopla are only actually accessible to registered letting agencies. So if you were a private landlord, portfolio landlord, or a smaller company doing lettings, you couldn't advertise there. And I spent ages trying to figure out like the user interface of Rightmove of like how do I post an advert here? I thought it was going to be as simple as Gumtree. So what we did there was I met a friend at university who was doing a computer science degree, and we decided to create a property advertising business where a landlord could come to us as an online agent, and we would then syndicate the advert. So we made it really easy for them
Mm.
to post an ad. Um, we were it was a terrible business. It was an amazing product and a terrible business. So this is back in 2010 when the iPhone was like still brand new. And we actually had it that you could go around a property, take the photos with your iPhone, upload the advert and to our website, all on your mobile. And then we would send it to Rightmove, Zoopla, and Gumtree. And we built this really sophisticated system to take any calls that came back from Rightmove, and the user would put in an ID number and it would route it through to the landlord that had advertised that property so that we could send all the leads right back to the correct landlords. And we spent 3 years running that business, and we did really well. We won a big pitching competition where we got £50,000 of investment. We won a competition by Virgin Media Pioneers. We got investment from Richard Branson, got to meet Richard Branson, have lunch with him, get advice on how to build the business. But ultimately, the business failed, and there were probably three reasons for that. we were charging. Do stop me with questions if you want. I'll just
I
blather
will. I
away
will.
otherwise.
Yeah.
So we were charging 49 pounds per advert, and we had a competitor company in London called Rentify, and they raised 12 million pounds of funding from Boulderton
Mm,
Capital, and they offered the exact same product completely free to acquire users.
mm,
So it was
mhm,
very difficult to grow commercially. That really killed the business. There is another company that was a competitor to us as well called OpenRent, and they are now the market leader. So interestingly, Rentify, I think they went out of business or pivoted, but OpenRent continued to scale and grow. And I think one of the reasons that they did well was that they were London based, and the tech community in London was way better than in Edinburgh, where we were based. Edinburgh didn't have any successful tech entrepreneurs, it didn't have good mentorship, there was no understanding of technology funding and how those technology companies should be built. And London was way ahead. So those guys had some really good advisors. They also did raise money. We never raised money for that business. We won some competitions, but we never raised angel investment or
mhm,
VC money, and they did, and they've continued to grow really well, and they're a very profitable business, and they're doing very well today. And I think our third reason for failure was, even though another company has sort of succeeded in the market, it was an incredibly small market. So we were selling to UK
mhm,
landlords, and there's roughly 2 million UK landlords. Over half of them only have one property. So there's not really a big market demand for them. The majority of those that have got a small number of properties, they use a letting agency to do all the advertising anyway. So we probably had like a target market of really maybe two or 300,000 potential customers that might transact
mhm,
only
mhm,
once per
mhm,
year, with a value of only £49. The other difficulty was that demographic of customer. They're like, those landlords are in their 50s, 60s, 70s. Back in 2010, they didn't have iPhones. They weren't interested in advertising
mhm,
online. There was
mhm,
still a lot of newspaper advertising back then. So it was a good lesson that you can build an amazing product. The technology we built was really
mhm.
best in class. But if there's not a big pent up market demand and there's not a big market, or if you've got well funded competitors, like, business is definitely not about the best product winning.
Amazing license, first of all. I have a sub question around when a VC backed company enters your space. I'm curious how you think about that now, or how, how would you do that differently? Because I actually see that quite often. I'm seeing it right now with a friend of mine. They build a company that is doing around 10 million in revenue, or close to 10 million. And now, but then bootstrapped, right? Completely bootstrapped. They've been doing it for 10 years or so. And now, well, maybe like over the last 3 years, one very strong VC backed company entered the market, and they're struggling, obviously, because suddenly they cannot compete on the price anymore, right? Somebody comes who raised probably like 100 million or so, right? So it's very, very difficult to compete with them on the price. And that can happen pretty much in any market. As soon as, if it's an attractive market, if it's a big market especially, that can happen very quickly. I'm curious how you think about that now after going through that.
Yeah, it's a fantastic question. I think that differentiating on price is, when you're in a commodity industry, is always going to be an issue. Um, I think the only way to survive is to have other differentiators,
Hmm.
particularly the fundraising stage. And you mentioned this is a bootstrapped business, but if they had fundraised, they would have been pressed and peppered by questions from investors on how do you build a moat, how do you build defensibility, how do you have customer lock-in. Um, I don't necessarily think competition is a bad thing in a big market. So if you look at like the car market, there are many multi-billion-dollar car brands who are often very similar. I mean, like,
Mm, mm,
how different is Mercedes to Audi? Like,
mm,
so I think that maybe their issue is less one about competing on price and more about customer acquisition and retention. So the questions I would have are, how can we acquire customers more cheaply than the competitor, or how can we lock in exclusivity with partners to deliver business to us that the competitor can't get? And then it would be around retention and branding. Like, how can we differentiate the brand that
Hmm.
customers return to us? We're better known than customers. I think a lot of the most successful entrepreneurs that have built really big brands, they have worked exceptionally well with the press. So if you look at the
Hmm.
cost of acquiring customers through paid advertising versus having amazing relationships with journalists and really creative campaigns and getting a huge amount of press coverage, like that's a great example of an unfair advantage where maybe you've got a
Mm.
VC competitor who's burning money on ad spend to acquire customers, but you're acquiring them super cheaply because you've got amazing relationships with the press. So it's complicated, but as long as there is a big enough market, um, there are solutions. I think probably the only solution is that is not a winner is competing on price, because then your margins are going to erode and your ability to
Yeah.
reinvest is going to go down. Um, I guess the other thing that I would imagine is maybe a bit of a waiting game. Those VC backed businesses often have an issue with being able to re-raise. A lot of them go pop all the time. I mean, I was completely surprised when Wonga went bust. The loan company, like absolutely huge. How did they possibly go bust? But while it might feel like a lot of pressure for your friend, I wonder if they keep their head down and focus on their numbers, maybe it just won't be an issue in 2 or 3 years.
All right, before we continue, I want to take a second to talk about our sponsor. I've always been saying that one of the best ways to learn about business is by working closely with a smart and successful entrepreneur, and this might be your opportunity. Our sponsor is a company called Judge Me. Judge Me is a Shopify product review plugin, and they're the number one plugin on Shopify. They're literally, if you look at the Shopify App Store, they're in the first spot. They're bootstrapped and they managed to outcompete other companies that raised hundreds of millions of dollars by just being smarter and building a better product. They were started by PJ, who was also a guest on the Founders Lounge, episode 54. So I recommend you to check it out. They recently moved their headquarters to London and they're looking for smart people to join them. They're looking for product managers, engineers, and they're looking to fill other roles as well. So check out careers.judge.me and see if you find any role that you like and apply. So that's careers.judge.me. Now enjoy the rest of the episode. Could happen. Could happen. Yeah. Very good point as well. That is very true. Um, right. So there was so with the then the next thing, I guess, the next thing on your journey wasn't the property invest. Would you call it property investment business or yeah?
Yeah, for sure. So, in some ways, I feel super lucky that I started to work in the lettings industry, because when I was in my teenage years, I was going and showing tenants around properties. I was doing lease agreements. I was learning about property renovations. And age 22, I was lucky enough to buy my first property, and I feel super fortunate because I put in a really low offer in on a property, and it got rejected. And about 3 months later, the estate agent came back to me and said, actually, the sale's fallen through. We'll take your low offer. And I also got a huge amount of support from my family. Like, I borrowed money off everyone, like my grandparents. It wasn't just the bank of mum and dad. It was grandparents, it was siblings, it was everyone, to be able to buy my first property. And this was well under £100,000. It wasn't anything fancy. But that property, it had an unused basement. So I was able to apply for planning permission. It was an old building in Edinburgh, so listed building consent. And I was able to turn it from a one bedroom property to a two-bedroom property. And this is really
Mm-hmm.
where I got very fortunate and kind of learned a lot of the economics of building a property business, where you can buy a property, renovate a property, and as long as you add enough value, you can remortgage the property to strip all of your money back out to be able to grow the business. So, for example, just as very simplistic numbers, say the property was bought for £100,000, and let's just assume that you bought this all in cash. You have money sitting to invest. You buy the property for £100,000. You spend £50,000 renovating it. So you spent £150,000 on the property. You've increased the size of the property, you get it revalued by the bank, and they now value it at £200,000. So you say to the bank, great, I want to take out a 75% loan to value mortgage against this property. All of a
Mm-hmm.
sudden,
Mm-hmm.
the bank has just given you £150,000 back, which you can go and
Mm-hmm.
reinvest. You've created £50,000 of equity, 25% of the property. And as long as the rental is covering the interest payments, you're just making money on what has become a free asset, and you can roll your cash into the next property development. And with Eden Limited, that's what I've been doing since 2012, is just buying properties, renovating them, holding the properties, letting them out, and accruing the capital to keep growing that business as a passive income generator.
I heard about a similar story recently from somebody in the US. I'm trying to find his name. I think this is him. Um, Logan Rankin. Have you heard of him?
I have not heard of him. No.
Logan Rankin. I'll send you his YouTube afterwards. But he did something very similar to what you did, and I like. So this is the game that I don't understand at all. And whenever I'm talking to somebody, it's so fascinating when you explain how this financing works. It always blows my mind. So he started maybe a few years later than you, but so what he did was he had a pretty good corporate career. I think he's just a very very smart guy, because you can tell he was getting promoted. I think he worked for a Fortune 500 company, or Fortune 50 even. Got promoted very very quickly in the first few years, saved up a few tens of thousands of dollars, and I think then both himself and his, was it wife at the time, invested all of that into their first property. And then they did the same. I'm not sure. I know that they do renovations now as well, or repositioning, which I think means renovation often, or kind of you change a little bit who you want to attract with the properties. Now, 10 years later, so and then they were just very good at reinvesting all that money, and essentially just investing all the money that they had. They kept their jobs for a few years, invested all the money that they had back into properties. Now, 10 years later, he has a portfolio of, I want to say 400 units, over 4,000 apartments. I don't, thousands of apartments. Let's say somewhere between 4 and 8,000. I don't remember the exact number. He's the owner of all of it. He didn't take any external investors, and it just blows my mind how you can grow that so quickly. I think the total value of that is somewhere over $500 million, which is just mad.
So I think it's easy to get carried away with these success stories and not see the risks, the issues, the failures. So there's a big risk with over leverage here, where
Mm-hmm.
potentially you borrow a ton of money and then you have a cash flow issue, you default, interest rates go up, banking covenants change, you breach your covenants. Like, there's also a huge headache of management overhead, which shouldn't be ignored. Like, having 400 units is going to be a huge, like, boilers are going to break, people are going to default on the rent. Like, you need to have a great partner who's going to
Mm-hmm.
manage all of that for you. I think one of the things I learned in my own lessons is you need to understand the market. Like, it is possible to buy a new build property and live in negative equity. You can time the market incorrectly and you can get into property and end up in negative equity. You can also buy a property where you want to buy it as a buy to let investment, but actually the cost of servicing the interest is higher than you're getting in the rental, which is not
Mm-hmm.
necessarily an issue. It's going to create a cash flow issue. And unless the equity growth of that property is high enough, you could just be losing money on your investment. There's a lot of tax things to take into consideration. The other thing that I'm much more aware of now is, as I've sort of grown in my career, the value of my time has become much more valuable. And that opportunity cost of how I choose to invest it is also much more prominent. So with my first property, I did a lot of the renovation work myself. I managed parts that I couldn't do. I managed the properties myself in the portfolio for a long time. Now it's not really worth me doing that, because my time is more
Hmm.
valuable than the opportunity cost of investing that time in the renovation could be growing my software business, which has got much higher equity growth, and signing up customers is much better than doing all of the legwork in a property. You also have to have that little bit of sparkle of how are you going to add value, make the property really shine, which just takes a bit of creativity and work to furnish it nicely, present it nicely, and you also have to be a bit lucky. Like I probably offer on 5 to 10 properties a year, and maybe buy one or two. So like it's super competitive. Everyone's interested in making money in the space. And while there are people who go after it really aggressively, um, I guess my focus has been on software over the property. I see that more as my pension fund. Like I don't have a pension. I put everything into my real estate business, and I have it very low risk, like as low risk as possible.
I was actually going to ask about that because I often get into these debates with friends who are in property, and I've never, as I said before, I don't know much about it. I never invested in property, and all my savings are in ETFs. So, as you, somebody who has a decade of experience investing in property, what's your argument for property versus ETFs? ETFs, for just for those who might be listening and who don't know about it, ETF is does in my view, the simplest, the most low risk investment in the stock market where you're just following an index. You don't, it's super easy, super low barrier to entry. Um, and you just follow the market. And in theory, the market in the long term, the market is always growing. If the market stops growing, then essentially the economy collapses. If it stops growing for a long period of time. So,
So I think that ETFs make a lot of sense. A lot of sense. There's a couple of reasons why I personally don't like them. I've worked in large companies, and I know how crazily efficient, like inefficient they are, and I think that they're just not the best capital use. I also think that in public markets, you have no additionality. So, yes, you're putting your money into a company, but all you're doing is you're buying those shares off another investor. They're taking that money. You're not actually putting money into anything that is improving anything. Like, even the company that you buy, they're not getting any of your money invested into them. It's not like you're investing in a startup where the founders are going to take that money and build and create something innovative. You're investing into a zero sum game where you're kind of waiting for this big inefficient beast to grow. When I put my money into property, I'm nearly always buying old property that needs to be modernized. So the first thing that I'm doing is I'm massively improving the housing stock, which is like real additionality. I'm taking something that is horrible or not very nice, improving the area, providing a nice home for people, a great living experience. Personally, I would happily live in any of my properties. Like I've done them to a good standard where I'm proud of them. So that's like the personal reasons. But the financial reasons are actually way, 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 way stronger. The two big reasons, one are deals and the other is leverage. So in deals, when I sold my company, I had some money to invest in property. And I found a property I really wanted to buy, and it was off market. So it's being sold by an estate agent, not on the market through like a mailing list. And they wanted £370,000 for it. So the first thing I did was I phoned up the estate agent and I said, what would they really take? And the estate agent said, if you put an offer of 360, they'd probably accept it. So in my mind, like, just bank £10,000 by doing a bit of negotiating. So I applied for a mortgage to buy this property. All my financials are approved, credit, affordability, etc. And they send someone round to value the property. And I get a call from a mortgage broker, and he says, Sam, I'm so sorry, but the mortgage is rejected. And I'm like, why on earth is the mortgage rejected? This makes no sense to me. So he said, well, the valuer's gone round and they've actually valued the property at £435,000. And because you've agreed to buy it at £360,000, they have an automatic rule that if the purchase price is more than 10% below what they believe the market value of the property is, they won't lend. So it's like an automatic anti-fraud policy that they have, where they just want to say, you know,
Uh-huh.
is it really an arm's length deal? Are you trying to buy something below market value? Now, in this case, I had no connection to the seller. It was an off market deal. They just wanted to sell it cheaply. What actually was going on with them, because I asked the agent for more information, was they were building a new house. They'd run out of money. They needed to sell a property quickly to be able to finish
Mhm.
their house renovate, their new house build. So for your average investor, you are not going to be able to buy this property. Like, you don't have enough money. I was in the really fortunate position that I'd sold my software company. I had cash available and I could just buy the property straight away in cash. So I brought the property at the fair market value, £360,000. And instantly, day one, I've just made £75,000. If I wanted to, I could turn around and sell that
Mhm,
property for
mhm.
£75,000 in one day. I've been lucky in having a deal. Now, that's one way a deal can happen, but there's all sorts of ways that you can get deals in property. You can find a buyer and seller and connect them when you're not involved and take a finder's fee. You can just negotiate really well. You can go and find off market properties and approach the owner through writing letters and asking them to buy. But there's the ability, like, to make a massive return on day one through deals. The other thing that you get in properties, which is kind of related but slightly different, is purely if you're doing any work on that property that's like smart work, is you can get capital growth. So that property I renovated, and I probably added another £60,000 of value to the property by doing a great
Mhm,
renovation.
mhm.
Um, so you don't really get that in ETFs, those big jumps. You know,
Yeah,
it's just passive.
yeah.
But the second and more powerful thing is leverage. So even with higher interest rates now, it's possible to get 6% interest rate from the bank, and it's possible to find property investments where your rental return is 9%. So you can, let's say you borrow £1 million from the bank. Yes, you have to scale up to this, but the numbers, let's say you borrow £100,000 from the bank. You're paying £6,000 in interest. But if you are renting it for £9,000 a year, your 9% return, you're making £3,000 return on money that's not yours. You're making a return on
Mhm,
your
mhm,
leverage.
mhm,
And
mhm.
you're not doing that with ETFs. You're only making a percentage on your own wealth. Whereas when you borrow money and you understand debt property and properly and leverage properly, you are able to take huge amounts of money from the bank and earn interest on them. It's not even your money and you're earning
Mhm,
interest on it.
mhm.
And that's where
Yeah,
property really performs.
that is interesting. How, so you said that this is essentially, you don't spend a lot of time on it now, right? It's how much of your time goes into this?
Probably 5 to 10% of my time.
Okay, and that means, and you keep acquiring properties and renovating them.
So I will only renovate a property if I think it is an outstanding deal, because renovating a property, even with a project manager, is a lot of extra work and hassle.
Uh-huh.
My preference
Hmm.
is only to buy a property if it is in really good condition. But in terms of a place
Hmm.
to put a store of wealth and to not just generate wealth and get a return on it, but safely store it, property is still, I think, number one. Yeah.
Damn, you're making me reconsider my investment decisions. So, um, we'll need to think about this.
I think for most people, the reason that they shy away from it is that they don't have experience in it. Like,
Yeah.
big fan of the book Rich Dad Poor Dad. There's a lot of parts I don't like
Uh-huh.
about it, but in general, his main principle is unless you educate yourself about how this stuff actually works, you're never going to get anywhere. And understanding the numbers and the risks, like, it's scary, it's new, so a lot of people don't do it. I actually wrote a book, so I took that old domain from the first failed business, advanced2go.com, and I wrote a property investment book, sort of explaining step by step exactly how I've built a property portfolio. Um, I got to that stage in my early 30s where a lot of my friends were asking me the same questions about buying property and investment properties.
Of
So I thought,
course.
right, I'm going to sit down, write everything down, and then I could say, I'll really happily help you, but can you read this first? Because it'll probably answer all the questions.
No, that's awesome. Okay, I'm gonna link to that in the show notes. So if anyone wants to check it out, they can check out your book. Because yes, that's exactly the thing. That's like the ETFs are just so easy. You don't need to know anything. You just need to pick one. That's the hardest part. You just need to pick one and if you pick one of the big ETFs, you probably do okay. This is not investment advice, obviously. With everything that you were saying now, it's great, but it requires that there is more knowledge and risk involved, right? So
It's
I
also
think
about
it's a
work.
very
Like if you put
attractive
in,
and work, yeah.
yeah,
So it's very attractive. It's a very attractive option if you're putting the work to learn how to do that properly, or work with somebody who can teach you, or yeah, it's just a bit of more of an investment of time as well, and effort. um but very interesting nevertheless. So it's it does seem like a lot of people do it at some point in life. Well, often I think what happens is somebody who already acquires a little bit of wealth, and then they decide to put some of that into property, because then it's
that's the barrier
and you
to
put
entry.
some out of your time. Yeah, yeah.
Yeah, it's hard. It's like for nearly everyone in the UK, I firmly believe that um, owning your own home is probably a great investment where you can buy you buy a house that's bigger than you need, you get a tenant to help you cover the mortgage payments, you buy a house where you can better the house, putting in like a loft conversion. You're able to improve the value of the house, sit on it for 4 or 5 years, sell it, it's capital gain, it's tax exempt because it's your primary principal residence. Like, yes, all of this requires extra work and it requires the ability to have the money and to go and do the work. And it's hard. Newsflash, life is hard, but doing it can be, when you look at the actual numbers, you can make way more money, particularly taking into account tax, from putting some work into buying your own house than from your day job.
Hmm. Hmm. Awesome. Okay, sounds like we need to read your book, because actually you got me really intrigued. I think I need to learn more about this. And the thing is also that, well, I'm assuming that your book is written specifically for the UK, mostly
Yeah.
from a UK perspective, right? Because there's a
Yes,
lot
definitely.
of content on this in the US, and much less that I see, at least much less in the UK. So that's good. But now we've been talking about property a lot and property investing, but your main thing, as you said, is actually technology, right? And so I want to talk about LeadPro a little bit, because that was your then second or third company, I suppose, which you started, and that had a pretty big success in the end, right? Can you say a little bit more about what that was?
Yeah. So LeadPro, the actual limited company itself was called Property Technology Limited. That's how interested I was in the intersection between property and technology.
Uh huh.
Um, so LeadPro was a marketing software, and it really built on. You can sort of join the dots backwards. It built on my property experience, in particular the Advanced to Go experience, where we tried to sell advertising to landlords. And one of the biggest struggles we faced was finding customers, really hard to reach landlords. So I wanted to run a business again. I thought it's the best way to build wealth, to build equity, to add value to people, to take problems and make them better. And this time I decided to target estate agents. Now, one of the nicest things about having such a specific niche target is you can go on Rightmove and you can get a list of customers and you have all of their details,
Mm-hmm.
address, phone number. You can walk in and see them, you can cold call them, you can write them a letter, you can email them. It made selling and targeting way, way, way easier. The software that we built, it ended up being very successful. We grew it to a 37% market share. We got a lot of the big brand names in the UK, so Knight Frank, Savills, Winkworth, Carter Jonas, Belvoir PLC, Connell's Countrywide PLC, the largest estate agent in the UK with almost 15% market share just in that group. And what we did for them was, I guess a lot of businesses have this balance between being a vitamin and a painkiller, and we were really a painkiller. The biggest thing that these companies
Mm-hmm.
are looking for are new business. They want to find people who have houses to sell or have houses to let. And we built a piece of software that's exactly what it helped them do. It also helped them track all their marketing spend, their staff performance. Um, yeah, it was a really neat tool, and it's kind of crazily satisfying where some of my friends would, the tool was white labeled, but some of my friends would message me when they were looking at renting or buying a property. They'd be like, "Is this your tool?" And I'd be like, yeah, it's really cool when people are using your software. Um, at the end, in terms of processing leads, we probably grew it to a scale of processing, say, processing maybe 10 million leads a year. So it grew to quite a big scale of usage.
How can you talk a little bit more about your growth strategy? Because you mentioned before 37% market share. I think that was in like 6 or 7 years, and like 37% market share is just insane, right? Like how what was your where was your growth coming from?
So one of the sometimes I feel like I'm still learning the same lessons again and again. That landlord market was tiny with only a couple of 100,000 landlords, and they're really only spending £49 a time. So it's like a very small market. 37% sounds great. It's a lovely factoid, but the UK property market is very small.
Hmm.
So there's a long tail. There's maybe 15,000 estate agency businesses in the UK, but a lot of them are absolutely tiny. When you look at like a good enterprise level customer who's maybe listing 200 properties a month online to advertise, there's like only 50 of them in the UK. So the customer target base is actually very small, and it's one of the new company I'm running. I'm really learning the lessons of not repeating that same mistake and focusing on a small market. And this is, I think, a really nuanced point because there are a huge amount of advantages to a founder in being niche. Like in being niche, it's easy to understand the customer, understand their language, create good scale sales scripts and marketing materials, overcome their barriers and boundaries. That is a great advantage. Like have testimonial videos from customers that other customers trust. However, I think when it comes to building technology, you don't want to build niche software because then you're limited in your scale. So, what we built for
Hmm.
UK estate agents, you couldn't sell to a US estate agent. It was totally
Hmm.
different.
Hmm.
Um, yeah, so it's definitely a lesson about maybe starting to market into a niche, gaining market share in a niche, and then expanding into other niches. But making sure that when you're building the product, that you don't go too deep into your niche's vertical, that the features and functionality are not going to be useful to other niches.
Um, do you have a technical background?
No, non-technical background, but I have some product scars that have helped me understand how to manage technical teams.
Okay. Yeah, I was curious because it's. I mean, technology obviously is a fascinating tool, but it's also very hard, right? I do have technical background, and I've also worked. I think you did some product management, and I've done some product management. So building like product tools within a larger tech company, and it's hard. I mean, it's technology is not again super attractive and amazing and all that, but it's not easy to build software. There's a lot of problems that come with it. So yeah, I was curious how you're managing that. So basically, you just learned through managing other people.
So I think one of the books I loved was The Lean Startup. But in some ways,
Uh
I
huh.
think it's a terrible book to give to entrepreneurs because it sort of gives you this idea of go out and build an MVP. And when you go to build an MVP, you will always get feedback from the customer telling you all the bells and whistles you need to add, and they would buy it if it just had this and just had that. And you can get massive feature creep. But even building an MVP is super expensive and time consuming. I'm a
Mm,
big fan of two amazing resources. One would be the book The Mum Test, really short
mm-hmm.
book
Love
about
it.
being able to hear the
Yeah.
signal in the noise. Massively valuable. Every couple of years I find myself rereading it to refresh the lessons. The other is the Google Design Sprint methodology, which is
Uh-huh.
way I'm not sure if you've come across it, but there's a couple of
I've
videos
used
about
it.
it.
I've used that once years ago. So I'm not. I wouldn't say I'm very familiar with it, but yeah, I know what it's about. Yeah.
Yeah, so the idea is rather than create an actual MVP that works, can you mock up something that doesn't work but takes
Mm-hmm.
99% less time and effort and energy and cost? And when you take that mock up to the market, if you're using, the mum test to interrogate, to question your customers and validate your assumptions, can you maybe get 80, 90% of the learnings that you would from an MVP? And the answer is like, yes, you can. So in terms of product development, I think the first thing that you want to do is really validate customer assumptions as cheaply as possible. And there's this big pressure to, particularly for founders seeking investment, you'll often hear investors saying like, "Oh, we need to see an MVP, we need to see early stage traction," and I think that can be a real red herring. Where actually, it would be better to do a design sprint and take your first series of assumptions and test them. Maybe do 3, 4, 5 design sprints. Maybe spend a month running a design sprint a week and really learning and failing fast all those little times before you start building absolutely anything.
That's such a good advice. And it's funny because I actually think this applies to somebody who's a completely new, who's just starting as an entrepreneur, as well as somebody who's started a few businesses already. Because one thing that I see people doing after you had one success, a lot of people fall into this trap of, oh, now I know how to do things, and they build something and they invest a lot of their money. I had somebody on the podcast actually who spent $1 million on, it was almost $1 million on building a new software, new tool, and in the end they had to shut it all down because they just realized that actually, first of all, nobody was buying it, and after a while they realized it just doesn't make sense. There's no need in the market for that. $1 million of their own money, right? Because they've been very successful in the past and they launched successful products in the past. So it's so easy to fall into that trap when you just feel like, for whatever reason, you feel like you know what you're building, you know what you're doing. But
Yeah, having
yeah, it's
success
always
once
good to
may
be
may have been
humble
down
and
to luck. You, like maybe
yeah.
you built a huge business, but you got super lucky. Um, yeah, I think find like the I really enjoyed the book Oversubscribed by Daniel Priestley, where
Hmm.
he talks about like, can you a lot of what he talks about is waiting lists. Like, can you don't necessarily have to have a product to sell. You can find out if people are interested in it. You can have notes of interest. You can have a waiting list. It's one of the reasons why I love Kickstarter. Like, it's such a smart idea that you're not going to build a jetpack. If 50,000 people want to put £100,000 down, then you'll build a jetpack. And I think
Mm,
that that is 100% the right way for founders to do it, where they can have their landing page, drive some Google ads, try and sell, even if the output is just join a waiting list. And I'd say
mm-hmm.
one of the biggest skills that I'm still learning and I'm not good at is sales. And a lot of founders come to found a company because they have an amazing idea, but they're not able to go and market and validate it. And doing the
Mm,
marketing work first is the right way around to do it, rather than
yeah.
doing all the hard product building work and then realizing there's actually no market need for it.
So my friend and I, we started a bunch of different products or projects together. Some of them turned into businesses, some of them didn't. That's why I call them projects, because in the beginning it's just a project. It's like, well, there's this idea. How can we validate it as quickly as possible? And yeah, we just built a lot of landing pages and we try to sell it. A lot of it didn't require sales, as in um, conversation with the customer, right? A lot of it just required marketing. So you spend some money on Google ads, Facebook ads, whatever is the right channel, and you see what's the reaction. And you see if you get any conversions. You take them to a blank checkout or something, or you can just write, the product is out of stock or something after they go through the checkout. And it always feels it's funny because it always feels expensive because you're like, oh shit, now we'll be spending this money on ads, but we won't actually no revenue is going to come out of that. But what's really expensive, if you actually build the whole thing and order products, or build the product or whatever, now that's the really expensive thing. So ads are cheap compared to that.
I think it's also about time. Like, it is really expensive, not just in money, but in
Mm-hmm.
time.
Yeah,
And
yeah,
you want to iterate and learn as quickly as possible. Yeah.
yeah. Cool. And right, so then you sold the business, right?
Yeah, so we had some real ups and downs. We did two angel rounds. So we didn't raise a lot of money, but we did raise money for this business. And in COVID, it was very difficult. So in lockdown, so before COVID, the company was profitable. We'd scaled it half bootstrap, half angel rounds. We'd kind of spent years growing it, and it was profitable. It was running really nicely. Very happy with the business. Um, then COVID came, and every single one of our customers couldn't do any property viewings, and the market
Mm.
was closed. And of course, they all paused their billing on everything. They stopped paying rent, they stopped paying software providers, and we were no exception. But we still had staff to pay, and our biggest overhead was the team. So it was
Mm.
a really difficult time where I had to remortgage my portfolio to put my own money into the business. I had to go to our investors and I had to ask them to lend money into the company to keep us running. And I kind of learned that businesses businesses fail. Businesses is a lesson I already knew, but
Mm.
even profitable businesses, market trading
Yeah.
conditions can really kill the business. Now, we were super lucky that the property industry took off. Like 2020 and 2021 ended up being two of the busiest years for estate agents. All of them made record-breaking profits. Everyone wanted to move house after lockdown, and it was fantastic for us. So we grew really quickly. Um, we were also working hard, but it's important to say that luck has a like a big component. I think if we'd been in building software for restaurants, the pain could have continued for like a lot longer. The property market really
Mm.
bounced back quickly. Um, we had a competitor based in Sweden who were interested in buying us. They were VC backed, they had more funding than us. They didn't compete directly, and they saw how our suite of products could complement their suite of products. They wanted access to some of our customers, they wanted to sell our technology into some of their customers. Um, and they made an offer which seemed really good. It was a cash and stock offer. But when we dug into it, the way that they had valued, so they had valued us at something like three times revenue, and they had valued themselves at something like 120 times revenue. So,
Oh, okay.
like the percentage of shares that they were willing to give us as the equity component and the valuation in their business, it was a terrible deal for us. So we just couldn't
Mm.
do the deal. Like it didn't make any sense. We also had one of our customers who was a distributor, so they sold our software onto their client base, and made us they made us a couple of offers. They made us an offer in COVID when they knew the business was doing badly, and it was one of the most
Mm.
awkward phone calls I had because the CEO called me and he was like, "Sam, I want to make an offer for the business," and he made like a full on insultingly low offer, like absolutely terrible, and I was just like, he could see in my face, I was like, no.
Mm.
God, no. And the call lasted for like 4.5 minutes. And he was like, oh, well, thanks, bye. Um, but I knew that they were interested, and I kind of leveraged the other offer with them. We were growing, we were signing up a lot of their customers. They were one of our biggest customers. And they could really see how well the software was doing, and they knew that it was like a good thing. They were also doing, so they're backed by private equity, and they were doing a roll up, and they were buying a lot of other software businesses to put them all together to be able to then exit the larger group. Um, so I spoke to the CEO, and he wanted to make another offer. And I said, look, can I speak to the actual private equity owners rather than you? And I positioned it slightly differently. And I sort of said, I'm really interested in this offer, but I'd like to meet the owners of who's going to buy my business. Whereas what I really knew was the CEO of the company was never going to give a good offer, and it was going to be a waste of time. And he also, anything that he negotiated, he would need the private equity guys to sign off on anyway. So why negotiate with the middleman gatekeeper if you can negotiate
Mhm.
directly with the private
Mhm.
equity guys? So I got a meeting with them in London, in their Marylebone office, and I went in. It was kind of like very informal after work. I was in a t-shirt and trainers, um, and we met at like 5:30. Um, I got offered wine, but actually, when I started my company, I gave up drinking and I said I wasn't going to drink until I
Hmm.
sold it. So I'd been teetotal for years and years and years as I'd focused on building this business. So I said, "Oh, I'm driving. You guys go for it." So the two guys, they polished off a couple of bottles of wine and we talked about business and the business. And I decided to go in with the negotiating standpoint of, I don't want to sell the company. We've had other offers. We've turned them down. This is why I'm really excited about the growth of the business. All of which was partially true. I mean, I was excited about the growth of the business. It was doing really well. I had the strong negotiating position of, I was very happy not to sell it. Genuinely, I was enjoying the process and the journey. But at the same time, I did know that only a couple of years before we'd almost gone bust. I'd almost lost a lot of money. I was very happy to cash in my chips and de-risk my investment and my time. I also knew that if we didn't exit now, we would probably not be able to exit for like another 5 to 7 years. So there's like natural exit points for companies at like um, different scales where there's different numbers of buyers and types of buyers and volumes of buyers. And if we didn't sell at this, when we ended up selling in 2021, it was 5 years into the business journey, which is quite early to sell. If we didn't sell then, it would probably be another 5 years. And I didn't want to stay in the company for another 5 years because I knew we were close to reaching our market like cap. There weren't that many other
Hmm.
businesses we could grow into. Um, and I'm sure we could have figured out ways to grow, but it wasn't like this massive blue ocean of opportunity where we could sell anywhere in the world.
Hmm.
So I said to the hedge fund guys, like, look, I don't want to sell. Here's all the reasons why I'm really excited. I showed off some features of the software that no one had seen yet. And that made them really want to buy it because I just told them no. And they could also see like how
Hmm.
powerful and exciting it was. So they said to me, well, what is a number that you would accept? Like, what's your price? And I had thought of that before going in. So I sort of said, this is the price I'd sell at. And they said, okay, we don't know if we can do that, but let us figure out and come back with an offer if we can. And they came back a couple of weeks later with an offer where they said, we'll give you a cash component day one. We don't think your business is worth what you want for it. But if in 12 months you can grow to reach these targets, then we'll give you the full amount that you want. So, like,
Hmm. Hmm.
you think it's more valuable than we think, but we'll use an earnout as a mechanism for you to get the full value you want.
Yeah.
Um, and that's how we ended up selling the company.
Wow, that was a full behind the scenes. I love it. I felt like I was there, part of the conversation when it was happening. Congrats. So obviously, I mean, massive success, and sounds like, yeah. So a 12 months earnout is not even. I think that's a pretty good scenario. I mean, depends. Some founders manage to negotiate no earnout or like a month, or just like a month transition period, but uh, what's more difficult often is if you have like 3 years, 5 years, and that tends to be like a pretty long period of time to stay within another company, because you don't actually know. First of all, you don't know if you'll enjoy that role as much or not, because you kind of lose a little bit of freedom, a little bit of control sometimes. um Second of all is also, as you said, I mean, market conditions change, right? So saying like a 12 months earnout is like, okay, the risk is lower that the market's going to change. You can kind of see the trajectory of the company, you have some plans, and hopefully, if this situation is relatively stable, you can actually achieve those goals. 3 years, 5 years, like, oh god, who knows what's going to happen, right? Very, very hard to set some kind of realistic milestones for such long timelines. So yeah,
Yeah, for sure.
sounds like you got a pretty good deal, very good deal in the end. um which then brings us kind of to today, um, when you kind of jumped on the AI train now, did you?
Firmly
With
with
that,
both hands and feet. It's
nice. So
interesting.
what's happening now? What's your focus now?
When I was running LeadPro, it was a time where blockchain was going crazy, and involved in a few different startup communities, and had so many conversations about like the blockchain craze. And if you wanted to raise money, just put blockchain in the title of whatever you're doing, and VCs will throw money at you. And I could never really see it. I didn't understand why decentralized, decentralized. There are very few use cases that really
Mm.
made sense to me. And I don't think we've really seen any sort of, aside from the cryptocurrencies, we haven't really seen, there probably are a few, but not any that jump to my mind, any big blockchain successes. I think AI is fundamentally different. Like, is it a
Mm.
trend? Is it a bandwagon? Sure. But just as people said that blockchain was the internet all over again and they were wrong, I think the people that are saying AI is the internet all over again are actually right. Like, the technology is incredible and the things that we can do with it are outstanding. So when I had finished my earnout, I stayed with the company for a little bit longer. I ended up leaving in 2023. January 2023 was when I was free. And I spent some time doing property deals, investing the money I'd made from the exit. And I did think, do I want to do another startup company? I know that it is 10 hours a day behind the computer, 7 days a week. You can't switch your brain off. I'm not saying that's healthy, but it often ends up happening. Even when you
Mm.
do have more chill, normal working hours, there's always tension. It gets difficult. All that responsibility for paying for a team and keeping the business alive is on you. Do I really want to do that again?
What
And
was
it's,
the alternative that you were considering?
I mean, the alternative was just being retired.
Hmm. Hmm.
I had from my investments enough income to live on without working very comfortably.
Hmm.
So travel, learn how to salsa dance, start a family, be a stay at
Mm.
home dad, like have really good quality of life. Um, all of which I think are great things to do. I mean, it's interesting. I actually read a book called On Identity because when I left the company, um, I had a bit of an identity crisis because all my time was spent in the business. All my time was
Mm.
spent with my team, with my customers. Like, I know all my customers' birthdays, names, their kids' names, like, and then none of that existed or was relevant anymore because I was out of the company.
Mm.
Um, so it was a big question of like, what is the meaning of life? What do I want to do? What do I want to do next? And I spent about 6 months really working on that. I started working with a coach, which I massively recommend.
Mhm.
Really helped me understand my goals, what I want to work on. And I decided that, first of all, I enjoy the process of building product. Like, it's super creative, it's super problem solving, it's a really interesting skill. I am obsessed with the power of AI and I want to be involved with it. I want to be on the cutting edge. I want to be learning. I also, the lessons that you learn, unless you keep polishing those skills, they go like dull very quickly. And I learned so much during the sale of my company and the earnout. Um, I wanted to reapply those and see, can I build another company better, faster, bigger?
Mhm.
Um, Definitely want to have more of a work life balance. And I think that as I scaled the company in the last business, I learned a lot of lessons about properly delegating, really hiring A players that you can trust and fully leave them responsible for their areas so that you're not micromanaging and doing everything. And I do think it is possible to grow big businesses successfully without having to have it be 99% of your waking life. I don't think that's healthy. So I decided that I would run a company again, found another business, and I wanted to look at the assets that I already had. So when I sold my
Mhm.
company that we were selling to estate agents, I had a 3 year non compete. So even though I know the CEOs of all the largest estate agency companies, until October this year, I can't sell them anything.
Mhm.
However, what we did do was we integrated with a lot of the UK mortgage brokers. So we were doing lead management for estate agents. If you're selling your house, the estate agent says, well, why don't I introduce you to a mortgage broker? So we would be sending tens of thousands of mortgage leads to the largest brokers. And I got to know the brokers, got to know their technologies, their CRMs, their conversion processes. And I thought, wow, I could really see how AI could help mortgage brokers. So, for example, big UK mortgage broker has about 50,000 hours a year of calls with potential people that want to have mortgages. but that only progresses to 10,000 mortgages. So that's 40,000 wasted hours, operational costs of doing business. And I was like, wow, if you look at the future of work, this is like a perfect use case for AI. Like, how can we
Mm,
streamline the efficiencies here? So I've started a new company called OpenFi, and we are building conversational AI for sales. Our first product is Sales Talk, and we're really looking at automating the SDR, or sales development representative role. So if you have inbound leads on your website, can we chat away and have an amazing conversation with them and talk to those leads fully automatically with no team
mhm,
members having to do it? Can we pre-qualify those leads, educate those leads, answer questions about what they're wanting to buy, with the objective of then booking in a very high quality call in the diary automatically? And
mhm,
that's
mhm,
what we're
mhm.
building now.
Nice. What would you say is the biggest challenge right now in building an AI business? Like or let's say specifically your business, right? Because there's well, probably all sorts of things. Um, a lot of people talk about AI hallucinating, which is one of the issues that can happen. Then there's just how do you feed the information in? There's probably other things that I don't know about.
So I think the biggest challenge is it is the biggest strength is the biggest weakness. So the biggest strength is it's a blue ocean market where there is tremendous opportunity. The biggest weakness is there's not implementation category kings. Like, sure, ChatGPT is a category king of being able to use conversational AI, but when it comes to like implementing it in a certain field, those category kings are still being built. And what that means is companies are scared to be the first. They're scared
Mm,
of
yeah.
risks. They're scared of compliance, and I think that I was worried that we were too early with this business, but I think that we're just at the right time. There's just enough excitement that customers are overcoming that risk to pilot and trial because they see the power of it. Yeah.
How do you think of risk? Because I was thinking about that question before. You said you bought your first property when you were 22. And I know for a fact that there's a lot of 22 years olds who are listening to this podcast, and they're, they might be considering, they're like, okay, well, maybe I would also, buy my first property. But you're 22. There's a lot. I mean, you might think like you know a lot of stuff, but also there's a lot of stuff that you still don't know. Financially, you're probably not very stable. You're just out of uni, if at all out of uni. Um, how do you, maybe in that moment or now? I don't know if it's the same or if it's different. How do you think about risk? Because for a lot of people, that's one of the big things that stops them from actually doing something, right? And yeah, maybe when you're thinking about doing that first property deal or starting an AI company or whatever it might be, there's all these things that can go wrong, or all these things that you don't know.
So I think it's a big myth that entrepreneurs are risk takers. I don't think that is necessarily true at all. Um,
Mm,
I also think it's very easy to confuse risk and fear. Um, so, for example, buying a property and looking at the risks, I see them as exceptionally low. I knew that the interest component of the mortgage payment was way lower than the rental I would pay for the same property. So straight away, I know I'm saving a lot of money on my opportunity cost of renting. So there's zero risk there.
mhm,
The risk of
mhm,
the market crashing, super low. Also, if I know that I was going to be living in a property that, or renting a property out for 5 years, and I know that I'm on a 5 year fixed mortgage, the interest rate is always lower than the rental, I'm always going to have positive cash flow. Even if the property price crashed year one, if I hold it for 5 years, I have a very low risk of the property price not having recovered. So the risk there feels super, super low. The fear, really, really high. Doing something new,
mhm,
signing a contract, working with a bank, taking out a mortgage, asking friends and family or your parents to borrow money for a deposit, saving up for a deposit and being scared about putting that money somewhere. So I think the way that you overcome that fear is you fight fear with thought. What are the unknown unknowns? How can I educate myself about them? Who can I talk to about them? Can I simply write down stuff on pen and paper? Can I have my goals? Can I be clear about what the milestones are to get to them? What are the actual numbers? What research can I do? And then you get to yourself to a state where you're not scared anymore and you're ready to go for it.
Mm-hmm. I don't know, I love how you think about stuff. I enjoy this conversation. You're very methodical, but also you seem to be very clear in your thinking and how you approach things, or at least clear in communicating things. So, which is always a pleasure, to have a conversation with somebody like that.
Thank you.
Um, we're approaching the end, so I don't know. Is there anything else that we should have mentioned? Oh, you did mention to me before we started recording. You guys just closed a financing round,
Yes, we
correct?
did. We did. I think that I did think about starting this new business and not fundraising, but speed is of the essence, particularly in this market where conversational AI, there are many first mover
Yes.
advantages. So we just closed £500,000 pre-seed angel round for OpenFi, and I'm really delighted with the team we've hired. We've got a rock star team. We've got our first few clients. We've got a UK PLC bank as one of our pilot clients for the technology, working through compliance and onboarding. So yeah, it's a super exciting time. A ton of work, but a super exciting time.
Congratulations. I'm really excited to follow the journey and to see where it takes you. I think, yeah, as I said before, I don't know. I like how you think. I think you're gonna do well with this, as well as with your other businesses. So, um, Sam, thanks for coming on, and we'll stay in touch. Maybe we'll do a follow up. The AI is moving so fast that maybe we'll do a follow up. In a year or so, see where you are at that point.
Thank you so much for having me. I really appreciate it.